So what we're going to do now is look obviously at the early leavers, and we're going to consider this in a number of different ways. So we're going to look at the people that leave the scheme in the short term, so where they may be eligible for a refund of contributions. We are going to look at leaving the scheme and transferring the benefits elsewhere. So the transfer out and the reasons why you might want to do that, and all of the rules and regulations of transfer. And then we're going to also consider those people that leave the employer but ultimately want to leave their benefits behind them with the pension provider, with their ex-employer. And that's the preservation of benefits, preserved benefits. So generally speaking, in the majority of cases, and we will look at the exceptions as well, if you leave the occupation that you were in that provided you with a DB pension, your choice is get your money back out of the pension, transfer it out to another scheme, personal scheme, generally speaking, or leave the benefits preserved. Yeah, and they are your three options that we'll be exploring over the coming slides. So let's start by looking at short service refunds. And this essentially is going to be a potential option where you've done less than 2 years service and you've moved on to another employment. Now, it's not obligatory. It's not a given that you will be able to get a refund on this. But generally speaking, a scheme can offer a short service refund as an alternative to leaving the pension as a preserved pension, or actually offering you a CETV. So the first thing we're going to concentrate on is the refund. So 2 years is crucial here. If you've done less than 2 years service, there may be an opportunity to get a refund of contributions. And we're going to look at the tax position of that on the next slide. There is also a term of 3 months to consider. If you've done more than 3 months of service, then a cash equivalent transfer value must be offered by the firm in question. If you do take a refund, as we're going to learn, there is taxable implications for that. Let's look at this in a little bit more detail. So once somebody that leaves their employment and therefore membership of the scheme has done more than 3 months, then essentially they've got 3 options available. They can ask for a cash equivalent transfer value, which will need to be produced and provided in order for them to consider moving those benefits over to another personal pension scheme. They also, with over 3 months service, can essentially request that the money stays in the pension fund, in other words, that they maintain a preserved pension. Service of less than 3 months can automatically be refunded. You can also, if you've got over 3 months, but not over 2 years, so between 3 months essentially and 2 years service, the member is able to apply for a refund of the member contributions. And the contributions, generally speaking, will need to be taken and essentially will be given back, and you will forsake all of your access to the actual scheme benefits in the future. Now, the tax implications of this are that the first £20,000 of member contributions refunded will be taxed at 20%, with any excess above £20,000 being taxed at 50%. And it's important to recognise these, for you may get a question which tells you that somebody's taking a refund of a contribution. It will give you the number, and you'll need to apply 20% to the first 20,000, 50% to the excess above that, as essentially a taxable charge on the refund of contributions that's been made. Let's look at an example of this. So we've got Rupert's an additional rate taxpayer, recently left his high-profile role as a HR director for a FTSE 100 company, and during his 18-month tenure he was a member of the firm's final salary pension scheme, so a 60th scheme. His total member contributions equated to £23,000. Rupert obviously has got less than 2 years service, so should he exercise his right to a member's contribution refund, what amount of tax, if anything, will be payable? Why don't you pause this, Have a work out and see if you're correct and check your understanding with the answer on the next slide. So Rupert's tax status and the scheme accrual rates are insignificant to this calculation because we're simply going to work on the refund of the contributions. The first £20,000 of members' contributions are refunded net of 20%. 20,000 times by 20% is £4,000 of tax. The excess is taxed at 50%, so the other £3,000 will be taxed at 50%, which will be £1,500. The total tax payable will be £5,500. In taking the refund back of the contributions, all rights to the pension from the scheme would need to be exhausted and waived. So we're now going to turn our attention to the preserved pension option that's available for the majority of people. In fact, I think it's fair to say that the vast majority of employees that leave service and therefore leave membership of defined benefit pension schemes actually leave their benefits preserved behind them. And those benefits essentially are an option that's available, and provided that the scheme rules allow for it, or mandatory after 2 years of service. And at that point, when you leave employment, you essentially cease being a scheme member and become what's known as a deferred member. Now, as a deferred member, that does not mean that your pension is frozen. There's a common misconception that people have a frozen pension. The pension isn't entirely frozen. You certainly will not acquire any more years of service. Your salary that you had, your final remuneration or calculated salary, is going to stay the same. However, there is a legal obligation on the pension provider to revalue that pension each year against set amounts of inflation figures. In other words, whatever the calculated benefit when you left the scheme was, will continue to rise in line with CPI. And we're going to look at all of the different rules and regulations around this, and the limits that are applied, and the set criteria of revaluation, the minimum statutory requirements that firms are required to provide. But we need to make sure we understand the difference between revaluation and escalation. So we talked about escalation previously. This is the increase in payment of the pension, non-GMP, GMP, you may recall. This is to do with revaluation. This is a preserved pension you've left behind that must continue to essentially be inflation proofed, so that when you draw the benefits in the future, they have maintained their spending power to a degree and are comparable with the benefits in real time and in real figures to what they were when you left. So here's an example. Tanya, 41, recently resigned from her role as a sales director at a local engineering firm. She was a member of the company's 60th final salary pension scheme. Having undertaken 18 years service and with a final salary of £58,000, her initial preserved entitlement would be 18 divided by 60 times by 58,000, £17,400. It says that Tanya is 25 plus years away from her state pension age. She is. To protect her income from inflation, her pension with this provider, this local engineering firm, will be revalued each year to make sure it at least keeps up in value with today's terms. So the whole premise of revaluation needs to be understood for this exam, and the rates of revaluation are generally set by the scheme but subject to a minimum statutory requirement. And I think it's fair to say that the vast majority of firms put their scheme revaluation rates in line with this statutory minimum requirement. So the statutory revaluation levels are going to depend on whether or not the scheme was contracted in or out. It was never going to be that easy, was it? And the period of benefits accrued within the scheme. So just like escalation, there's different rates apply at different points. Any contracted out entitlements to guaranteed minimum pension or post-97 benefits Well, they also have their own revaluation rates. So essentially, we've got a difference on the revaluation rates for contracted in and contracted out, and then we've got different revaluation rates for contracted out benefits and non-contracted out benefits. Happy days. So let's have a look at these particular rates that we've got here. So this is a contracted in that we're going to deal with first. The ordinary rights that you've got to the scheme. So this is based on your leaving date. This is based on the benefits that accrued. This is tenure based on the example we've just done previously. So tenure would have had benefits accrued before the 5th of April 2009 and after the 5th of April 2009, and that's the cut-off when the CPI valuation dropped from a cap at 5% to a cap at 2.5%. So essentially revaluation is 09. You remember potentially escalation changed over in 05. So the way that I always remember this is that if you work from 9 to 5, you start at 9, you finish at 5. You revalue preserved pension benefits before they escalate. So 09 is the starting point. That's when it changed from 5 to 2.5. Escalation changed over in 05. So you need to remember these. You need to know these figures, that this is the standardised. Your pension benefits you've built up through your normal scheme are revalued at CPI, capped at 5, reducing to 2.5, and the swap over point was on the 5th of April 2009. Then we got those pesky contracted out benefits, which we remember a GMP, which essentially ran from 88 to 97, and the requisite benefits we called them, which was from 97 to 2016. And this is a lot more complicated, but you're generally not going to need to know the different rates that apply here for your standard R04 exam anyway. So GMP benefits, so this is your guaranteed minimum pension. Essentially, there was a set rate for each year that was announced and agreed by way of the the revaluation of your GMP benefits. And it used to be National Average Earnings Index, and then it was a fixed rate. So we don't need to know all of the difference between these two. The one thing you do need to appreciate though is that for revaluation, GMP does not work on CPI. Then we've got the post-97 benefits, the requisite benefits as we term them. These are valued at CPI, and again the 5% 2.5% spread exists. In other words, requisite benefits, the statutory minimum revaluation of those is actually in line with the main benefits of the scheme. So the one that sticks out like a sore thumb here is the GMP benefits, which is a completely different method of revaluation rather than anything else. So just to remember them, just to remind ourselves, revaluation is before retirement, escalation is in retirement. Both of them essentially have statutory minimums. For the main benefits, essentially CPI linked 5% or 2.5% in the main. Swapped over, revaluation first, 09, escalation 05, working 9 till 5. So the escalation comes after you start drawing your benefits and the revaluation is before. Next, we're going to approach the somewhat thorny issue of pension transfers. And these are transfers in the truest sense of the word here, where in essence you are going to be leaving the scheme and essentially moving the benefits ordinarily to a personal pension scheme of some description. So any member who left their scheme on or after the 1st of January 1986 has had a legal right to move that transfer, those benefits from that particular scheme to an alternative preserved pension. So essentially, The certain public sector schemes are exempt from this. We're going to learn which ones are. Some of them are unfunded schemes which you can't transfer. Also, there's some that are notionally funded that you also can't transfer. But the way that pensions are moved from a defined benefit pension to a defined contribution pension is going to be determined, and the amount is going to be determined by a cash equivalent transfer value, a CETV. So if you do want to actually give up what is essentially a guaranteed income from the scheme retirement age for the rest of your life, you need to move that into an equivalent lump sum, the value of those benefits at that point, in order to transfer a capitalised value of those benefits that replace what you're giving up, and that is what the cash equivalent transfer value is. So CETVs, cash equivalent transfer values, the value of any defined benefit pensions transferred out will be established by the CETV. It's mandatory for anyone with more than 3 months service, as we looked at earlier on. It's actually a cash equivalent of the benefits being given up, worked out by an actuarial calculation that is essentially done under firm guidance that's published by the pension regulator. You will forsake, in taking a CETV and then subsequently transferring your pension out, you will forsake your defined benefit for a lump sum which you will be responsible essentially for the success or failure of in the future. So let's have a look at this in a bit more detail. So if somebody essentially wants to consider taking the money out of their pension by way of a transfer, the first thing you're going to need to do is, and you won't do this personally, this is largely going to be done by the scheme actuaries and administrators, you'll calculate the member's preserved pension at the date of leaving the scheme. That, of course, will need to be revalued, as we've been finding out, to the date, essentially, of the scheme pension age. So you need to revalue the pension benefits at the date of leaving to the scheme pension age of the scheme that you essentially are leaving. From that, we will calculate a capital cost of purchasing the annuity based on the scheme benefits revalued to the scheme retirement age. Then, having fast forwarded up to the scheme pension age and worked out the lump sum, we apply a discount to bring that back to essentially a cash value that is applicable for today's money. So that involves the use of gilt yields. We don't need to worry about this in too much detail and follow the process in too much detail for diploma exams. For anything beyond diploma exams that this is being used for, then you are probably going to have further reading of these steps to understand this truly and completely for those purposes. So what causes higher CETVs? Well, things like lower annuity rates or low annuity rates, lower discounted rates, and higher revaluation rates create higher CETVs. So don't forget, you're replacing the benefits that you get. So you're giving up a guaranteed income. If annuity rates are really low, you're going to need a much higher cash equivalent value to buy that level of income when you leave, which is why lower annuity rates cause higher CETVs. The discount rate is what we bring the fast forward capitalised lump sum back into today's money in, and the lower that discount rate is, the higher the cash equivalent transfer value that's required. The higher the revaluation rates that apply in the scheme, the more essentially you're protected from inflation, the more it's going to cost to replace that, the higher the CETVs you're going to need. And complete and utter counter opposites here. This is a seesaw. So for lower CETVs, the polar opposite applies. If annuity rates go up, CETVs will drop. If higher discounted rates are used, lower CETVs will apply. If the statutory or lower revaluation rates are applied compared to higher non-statutory revaluation rates, then that's going to drive the lower CETVs. And one of the reasons that we've seen a spike in requests for pension transfers from DBs in recent times has been that CETVs are really high at the moment, given the fact that we have an ageing population drawing income for longer, and also we've got record low annuity rates driven by record low interest rates within the United Kingdom. Now, in producing CETVs, which have to be produced in a set format by the pension regulator, there are also situations where step 4, this discounted capital cost that creates a CETV, can be changed. And in some cases, there's a step 5. CETVs can be reduced and CETVs can be enhanced. So let's think about the circumstances where you might see reduced or potentially enhanced CETVs. And we'll start with the reduced CETVs. So the most common situation where firms are legally allowed to reduce the cash equivalent transfer value, i.e. the amount they give you to leave the pension fund. The most common situation where the CETV is reduced is essentially where the fund is underfunded. So where there's a scheme deficit, there is certain criteria that applies which can allow the scheme to give you a reduced CETV. The CETVs can also be enhanced in certain circumstances, and lots of firms have been through exercises trying to reduce their long-term liabilities and their long-term exposure to paying the income by offering incentives, bungs, so to speak, for somebody to take their pension out. So CETVs can be enhanced if the firm are keen to reduce their long-term liabilities. They essentially offer an extra bit of a Brucey bonus on top of your CETV to buy the member out of their entitlements and thus reduce their long-term obligations. Now, enhanced CETVs are commonly part of risk reduction exercises that are undertaken, and quite often they will focus on people that are over the age of 55, under scheme pension age or scheme retirement date, and they will basically have a 3 to 6 month exercise where they'll write to everybody that's in that bubble, tell them that legally they can take their pension benefits. Ordinarily it wouldn't be recommended because there might be penalties, but if you transfer it out, you can access your benefits with freedom immediately. And as an incentive, we are prepared to enhance that cash equivalent transfer value so that you feel more inclined to accept. Financial advice is of course crucial, mandatory in some cases when considering transfers, and we're going to look at the transfer rules on the next slide. So once again, we flag a risk warning here that we're going to talk about the transfer rules and safeguarded benefits over the next few slides. But this is specifically really intended as a revision tool for the R04 exam more than anything to do with the pension transfers exam. So you may need to go beyond the basics if you are using this as a resource for the advanced papers. However, we have a statutory right to transfer. We've talked about this, and that's been there for a number of years, meaning that trustees cannot refuse a transfer out of a DB in most circumstances. Now, we know that there are exceptions to this with public sector schemes. We've already said that, and we're going to look at those in much more detail at the back of this particular this module. But ultimately, in most circumstances, if there's a request to transfer to a registered pension scheme, then you can't say no as a scheme. So provided that your benefits are uncrystallised, not drawn, accrual has ceased, so to speak, in other words, you're no longer a member, you're a preserved member, a statement of entitlement has been provided, which you would request, and the member is not in the final year before the scheme pension age, those are essentially special rules that can apply. If that doesn't apply, then essentially, or do apply in some cases, then you have a right to transfer. You're going to need to take advice, not from any Tom, Dick and Harry, but from a suitably qualified advisor and it's mandatory in any circumstances where there's a member of a DB scheme who's got safeguarded benefits defined on the next slide and a cash equivalent transfer value or a cash equivalent transfer value in excess of £30,000. So essentially, in the vast majority of cases, because CETVs can rack up pretty quickly on defined benefit pension schemes, or anyone that's in any pension scheme that's got these so-called safeguarded benefits, you're going to need advice, and that's from a suitably qualified advisor. And the onus is on the pension scheme receiving the pension benefits to ensure essentially that a suitably qualified advisor has put their paw print on the application form and has provided advice to the individual as to whether this is the good idea or not. So we mentioned safeguarded benefits there. Let's just summarise what we mean by safeguarded benefits. So these are benefits that are neither defined contribution nor cash benefits. What does that mean? Well, generally speaking, it means the following. DB pension schemes with a cash equivalent transfer value above £30,000. Any scheme that has a guaranteed annuity rate, a set amount of annuity that is guaranteed to be paid when you start drawing the benefits. Schemes that contain guaranteed minimum pension, anything that's got a GMP, then essentially the advice is mandatory. Section 32 policies containing GMP, we'll talk more about Section 32 policies in another section when we look at the defined contribution benefits. But this is essentially a pension fund that has been set up specifically to receive the transfer from a DB, and it's somewhat historic nowadays. And anything that's guaranteed, other guaranteed retirement income benefits. So what we're saying here is advice is mandatory in these circumstances. There are certain additional qualifications that's required in relation to the top one. In other words, if you've got CETVs from a DB of 30,000 plus, that's when the enhanced authorisation is required, mandatory requirement for the movement of benefits out. So any defined contribution benefits and cash benefits are generally known as flexible benefits, and these flexible benefits, of course, will be considered as per above. So what are the roles of trustees in the transfer of safeguarded benefits? Well, we've kind of worked on this already. So trustees of pension schemes must satisfy themselves to ensure that they don't make nor receive any unauthorised payments. And they play a pivotal role in the pension transfer process because they need to warn members of potential scams that are out there. And secondly, they need to make everybody aware where there's a request for a CETV of the need for advice. So you'll often get sent with you the CETV, you'll get sent a attaching document that will warn you on the fact that there's potential scams out there. So trustees will arrange for a CETV, a statement of entitlement, to be produced. There's no legal obligation to produce this every year. They only need to produce this essentially under certain circumstances, mainly for our purpose, a request from a member. And this CETV, this statement of entitlement, is going to provide a guaranteed date, and that guaranteed date essentially is the time frame by which the transfer must be concluded in order for that CETV that's quoted to be valid for. We're going to look at the example process of this on the next slide. So this isn't really straightforward. Why would it be? It's a pension transfer. But we need to just get the general sense of this, particularly if you're using this as a resource for R04 rather than for any other of the advanced papers. So what must happen if there's a request essentially for a statement of entitlement that's received from a particular member, or there's an event that gives rise that needs to have these produced? Well, within 1 month, technically speaking, of the request, trustees must notify the member of the need to take advice. So generally speaking, this will be a return acknowledgement perhaps that says thanks for your request. We note that, and by the way, here essentially is the some details about the advice that you need. Within 3 months of that particular request, they need to actually physically produce this statement of entitlement, which is going to advise the CETV, the value, and it's also going to quote this guaranteed date. Now, this guaranteed date, within 10 working days of that guaranteed date, that needs to be provided to the member with the statement of entitlement. Within 3 months of the guaranteed date, the member must make a written request to transfer, providing that the trustees have got evidence of the advice that's been taken. Trustees are obliged to check the advisor's credentials, and within 6 months of the guaranteed date, the trustees are to send the CETV to the new scheme, i.e. the value needs to be forwarded to the new scheme. So a couple of milestones in here. We've essentially got this 6 months link. We've got the 1 month of telling that you need advice, and essentially you've got the 3 months to produce the statement of entitlement and advise that guaranteed date. So quite often the tipping point of 3 months in the middle is where the paperwork needs to be provided, and then essentially the transfer needs to conduct or be concluded within 6 months, or there may be a requirement to go back to square one and start this again. So it can be quite time pressured, a pension transfer. Certainly nobody should drag their heels in relation to any of their obligations.